So what is a condo corporation loan? It's an unsecured commercial loan to the corporation. So what does that mean in plain language? Under the Property Act, there's very specific measures you have to take in order to pledge any type of security or mortgage over your common property. For us, we're an experienced lender. We treat these as cash flow loans. So we don't ever take a mortgage over your common property or your individual units. These are unsecured loans, meaning that there's no traditional security. If you compare and contrast this type of product with a personal mortgage, a residential mortgage like you have over your unit, chalk and cheese, completely different. Your personal mortgage, you have to go through the income verification process. You have to have an appraisal done on your property. It gets registered on your title. It gets registered on your credit bureau. So it's very, very secure. The bank owns your unit until every single penny is paid in full. Whereas with one of these commercial loans, it's treated as a cash flow loan. We call it a cash flow loan in the banking world. So it's a loan to your business entity. The corporation itself is the one that holds the loan. So there's no security registered on, there's no mortgage registered on the corporation itself. There's no security or mortgage registered on anyone's individual units. If you're in a corporation that has 50 units, we do not collect 50 different credit applications and personal net worth statements and proof of income. We look at the credit worthiness of the corporation itself. So the corporation is the borrower. There's no security placed on your units, and there's no registration on your individual title or on your credit bureaus. The loan is held by the corporation, so it's quite different. Again, that unsecured meaning you're not pledging any specific property in terms of a mortgage. So completely different product from a personal residential mortgage. It's subject to a positive resolution approval. So your bylaws would specify whether it's an ordinary resolution or a special resolution. There were some changes made to the regulations last year that specified if your bylaws are silent, meaning there's nothing specifically in your bylaws that says you need to do an ordinary or a special, then it defaults to an ordinary resolution. So it's always subject to the will of the group. We already talked about no personal guarantees or security, and it's repaid monthly by the owner. So that's where the cash flow comes in. We lend the corporation money, it gets repaid monthly by the owners. It allows the corporation to have access to the full amount that the resolution is borrowed for right away, which means that you can get going on your project right away. There's no delay in funds, which can be a very positive thing when the corporation is trying to enter into contracts. In terms of the loan structure itself, so we already talked a little bit about the security. The main security from our perspective is the future cash flow from the owners. So if we have a corporation that's doing a window project and there's 50 units and it's being repaid monthly by 50 different people, there's a nice disbursement of risk there. So we like that there's income coming in from 50 different places to the business entity, and the business entity makes one payment to us as the lender, because that's where the relationship is, corporation and lender, and the payment's made that way. And the corporation collects the income from the owners. They're generally speaking 5-year renewing terms, amortization periods up to 20 or even 25 years. The general concept behind the amortization is we don't want you still repaying this project and you have to do it again. So if you look at something like, a fence project that's going to have a shorter lifespan, we'd probably set up like a 5-year repayment. So you're not still paying for this project when you're going to have to replace the fencing again. Whereas if you're looking at doing a large building envelope rehabilitation project with long life materials such as hardy board, new windows, that's going to last you guys 30, 40 years. So we can easily look at some extended amortization options up to 20, 25 years. Those are the parameters that we work within, and we give options back to the corporation. So part of what I do, again, in that getting to know my client step, is talk to the board, give the board some different options. Here's a 5, a 10, a 15, a 20-year option, and we can look and see what's going to be the best option, the most palatable for the owners.